Airbnb just released earnings. They beat both top and bottom lines, but the stock is going down after hours due to Q4 guidance, ranging from $1.8 to $1.88 billion, slightly below analyst expectations of $1.86. In case you are wondering if it's time to buy or sell, I'll do a full stock analysis, going through the main aspects I like and dislike in their business. I'll also show you what I think good buying prices are, using my discounted cash flow model, based on their updated numbers and comments made during the earnings call. Let's begin with the good things about their fundamentals, what I consider pros in their business. Brand recognition. Their name Airbnb is pure gold. It became an industry synonymous, like Google, Band-Aid, and Xerox, just to name a few. This gives them a huge advantage over competitors, leaving them in a position where they don't need to spend much on advertising. Their main growth has always been through word of mouth. Founder-led company. In most cases, and there are a lot of exceptions, I think founders running business is a great advantage over those who have traditional corporate managers. When founders grow with the company as serious professionals, they tend to achieve greatness. They are obsessed, resilient, take advantage of unclear opportunities, and often thrive during crisis. To me, Brian Chesky has a lot of these characteristics. He created Airbnb during the 2008 crisis and tried selling 10% for about $150,000. Dozens of potential investors rejected, telling him it was the worst idea in the world and it was never going to work. But he is resilient and did things most wouldn't, like going to people's houses taking better pictures or selling Obama-O's cereal to fund part of the initial operation. During the 2020 crisis, instead of staying still and let the cash burn, he shrunk the company's size, improved the user experience and created new services, such as travel insurance. They still had a bad year, but manageable compared to the disaster it could have been. Massive user base. They got so big that their users became their moat. It's pretty hard to create a similar environment. Because they have most listings and a platform with a great user interface, people looking for a place to stay that is not a hotel go straight to Airbnb. At the same time, because everybody is looking for places to stay on Airbnb, new people wanting to rent their place don't even consider other platforms. This cycle generates a massive organic growth. Healthy balance sheet. In terms of balance sheet, Airbnb is looking pretty healthy. They have $6 billion in cash and another $2 billion in short-term marketable securities against only just $2 billion in debt. The rest of their relevant liabilities is very well balanced with their other assets. And they also generate positive cash flow, putting them in a comfortable position to reinvest heavy into their business, acquire other companies if the opportunity comes up, and even do some share buyback. Revenue growth. Airbnb just reported its highest revenue quarter in history, $2.9 billion, summing up to 6.5 in the last 9 months. If we look at prior years, with the exception of 2020, we can see they always have very strong revenue growth, above 30% per year. Due to all the reasons I mentioned previously in this video, their business is extremely scalable, and they know how to do it. Free cash flow and profitability. Unlike most recently public traded tech companies, Airbnb is making profits and generating free cash flow. They actually bought back shares in the last quarter, which makes them look like aliens around other mid-cap tech stocks. It's pretty hard to find a disruptive company with such healthy numbers. Moving on to the cons. There are a lot of competitors in the space, all the hotel franchises with their standard services, and other tech companies like Booking.com, Vrbo, Expedia and more. Even a company like Google is kind of a competition for them. They have Maps, Search, and Google Travel, where you can easily find places to stay. I believe Airbnb has the best solution due to the user experience, the massive user base effect I mentioned on the pros, their golden name, and the advanced tools they have built for both hosts and guests. But still, it's a very competitive space, and their tech is not that complex to copy. Different jurisdictions and regulations. Every time a disruptive business model comes up, there are many legal and bureaucratic obstacles involved. And as each city, state, and country has its own laws and ways to do business, an international company like Airbnb has to deal with an immense amount of these obstacles, constantly getting sued and fined for all kinds of reasons. So far, besides millions of dollars paid in fines, they seem to be doing okay, but it's always a risk we have to consider in their business. They don't control big part of the operations. It's hard to keep a good standard on houses all over the world, you never know what hosts are up to. Just as an example, a couple rented an Airbnb and they found 2 hidden cameras, one facing the bed and the other in the bathroom. It's also pretty hard to know what guests are gonna do. To try solving this problem, Airbnb created an anti-party policy and developed an anti-party tech algorithm, automatically identifying possible party makers and preventing them to rent big spaces. Although they are taking all these actions, there will always be trouble, things they can't control and will have to take responsibility for. Macroeconomic scenario. Another con I have to mention is that traveling is highly impacted by relevant macroeconomics events. If we really go into a deep long recession, people will travel less, which will slow their growth significantly. Brian seemed pretty confident on the conference call, saying he actually believes a recession would bring more listings to the platform due to more people needing to make an extra buck, which they would be able to capitalize on. Now, let's see how their prices compare to my buying targets. I'm gonna consider 3 different scenarios, a base case with my most realistic assumptions, a best case being a little optimistic, and the worst being more bearish. It's also important to note that my assumptions consider the next 5 years. For revenue growth, as we've seen earlier on the video, Airbnb usually grows well above 30% per year. Because we are going through very uncertain times, I want to be conservative, so I'll consider 20% average growth on the worst case, 25% on the base and 30% on the best, which I think is achievable as an average on the next 5 years. Share change. For the past couple of years, Airbnb has been issuing shares, but they now started buying them back. I don't want to be too optimistic here. I'll do 1% dilution on the worst, 0 on the base and 1% of share buyback on the best. On profit margin, as they just became profitable, let's use their last 2022 9 months margin as a starting point. They did 24% margin, and I believe this tends to increase as they scale the business. It's not unusual for a software company to get 30% margins. As we need to consider an average for the next 5 years and I want to be conservative, I'll do 22% on the worst, the current 24% on the base, and 26% on the best. Price to earnings. Their current PE is around 37, and because they recently became profitable, we don't have much of a track record to analyze like I usually do. I think Airbnb is a great company, and with the growth rates I assumed, the following PEs are pretty reasonable. 23 for the worst, where they grow 20% per year, 28 for the base, and 33 for the best case. The last input is the expected returns per year. I use 15% on all scenarios, giving me a good safety margin. Great. Now that we've gone through all the assumptions, let's find out what a fair value is for the stock considering these scenarios. Keep in mind that this is not financial advice. For the best case scenario, my most optimistic assumptions, I got a fair value of $226, a 120% upside potential. I know it seems way off, but I think the market has overpunished some great companies that are now very undervalued, a scenario I don't expect to remain 5 years from now. The price I got on the base case is $139. If this turns out to be true, then we are looking at a 37% gain to get to fair value. On the worst case, the fair value for the stock would be $85, meaning current prices needs to fall by 16%.